Orlando has changed significantly over the past couple decades. Orlando was typically known for Disney World and the parks. I think that has changed substantially over the past couple years. We have Lake Nona, South Orlando, bringing in a lot of the medical space. Obviously, UCF, one of the largest universities in the entire country. For living here for 35 years, like you can get from one place to another in 20 minutes, and now it's one place to another in 45 minutes.
All right. Hello, everyone. We have another episode with the one and only Ryan Moody from Orlando. Ryan, how you doing?
Doing great. How are you doing today?
Great. Thanks for hopping on. I'm going to give a quick intro. Ryan Moody. He's Executive Managing Director with Newmark, based in Orlando office. In this role, he focuses on multifamily brokerage, investment sales, and land sales, primarily in the greater Orlando, Central, West, and North Florida markets. Ryan focuses on the value-add product type across these regions. Ryan has been in Orlando resident for 35 years. Wow. Nice. So, and I'll also add Ryan is amazing to work with. Closed a few deals with him in Orlando. And he's got a lot to say about the market. So, Ryan, thanks again. Let's jump right into it.
Yeah, absolutely. Thank you for having the opportunity to join with you today. Looking forward to discuss the Orlando market. So yeah, go for it.
Awesome. So I think first question, we'll just get straight to it. Why Orlando? Give us the 30,000 foot overview and elaborate just a high level pitch on why should investors be bullish on Orlando?
Yeah, I think, Orlando has changed significantly over the past couple of decades. I mean, when Orlando was typically known for, Disney World and the parks, I think that has changed substantially over the past couple of years. Obviously we have a diverse employment set now with Lake Nona, South Orlando, bringing in a lot of the medical space. Obviously UCF, one of the largest universities in the entire country, minus our football team being very poor this year. It just seems that if you draw a big circle over Orlando, you can look at either North Orlando, South Orlando, Central Orlando, or East Orlando, and there's going to be great office markets and employment. Yeah, so it's the employment sector, typically, it's been highly, about 25% of hospitality. Now we're seeing that the employment sector more like professional and business services at 19%, education and health services pushing like 12 to 13%. So the employment sector is completely different than what it was 20 years ago when Orlando was known for Disney World. So I think that's one of the major drivers for Central Florida. In addition, Orlando's been one of the top transactional markets over the past several years. So we have outperformed on the number of transactions really throughout the entire country. So, there's a lot of opportunity for growth. It depends if you're a buy and hold or a buy in, sell in a few years. It gives you the opportunity and the flexibility to do both.
Nice. And I would add to that, when we're looking, and we opened our office in Miami about 3 years ago, we were looking at different markets for immigration patterns, and we were shocked to see, shocked at the time, but not shocked now, that Orlando has one of the strongest immigrations of the major Florida MSAs, bigger than Miami, more than Tampa. And that's what keeps us pretty bullish on it as well.
Yeah, absolutely.
Yeah, go on. What were you going to say?
No, I was, saying kind of side note. Yeah, I mean, for living here for 35 years, Orlando used to be, I-4 used to be you can get from one place to another in 20 minutes, and now it's one place to another in 45 minutes. So obviously it's great to see the growth, but traffic is, I feel like where you guys were used to be from, LA now.
Yeah. Yeah, LA traffic now is everywhere, it seems like, but
Yeah.
definitely
Yeah.
Orlando where it's seen a lot of growth. So Ryan, I mean, talk us through, we have the map up right now. Talk us through the different pockets when you say North Orlando, East, West. Where are some of like the borders? Where are some of the locational areas that lay the land of how to understand Orlando when you're looking at a map?
Yeah, certainly. So we'll start at the top. So North Orlando, which is your Seminole County submarkets, if you want to kind of dive into like the Lake Mary, the Sanfords, the Altamont Springs. So Seminole County has typically been known for the best grade schools in all of Orlando. So fun fact, Lake Mary was voted the number one place to live in the entire country for many years, quite some time ago. But you've got 9 million square feet of office space in Lake Mary, and a lot of that is Class A office space. So you've got a great office park in Lake Mary. Also in Maitland, which is hovering your Seminole and Orange County submarket, you've got several million square feet of office space there as well. So you'll find typically Seminole County is heavy residential single family homes. So there's not a ton of apartment supply in those markets. But I mean, really, if you're a family and you're looking to be in the suburbs, a lot of families are looking to be in that Seminole County submarket. So your Lake Mary, your Altamont Springs, your Ovitos, your Winter Springs, Sanford as well. So in and around that entire area, just great schools, great employment, and obviously, you're still close to the central Orlando, being 15, 20 minutes away on I-4.
And you're saying most of these residents are kind of working in that suburban office park you mentioned with the 9 million square feet of
Yeah,
space. They're
correct.
not really commuting down, or is it a little bit of both?
It's a little bit of both for sure.
Hmm.
So, I mean, the traffic flow into the city every single morning from Seminole County is going to be heavy to get into the core of downtown Orlando. But, you have, Verizon as one of the headquarters in Lake Mary and Sanford. So you've got a lot of bigger names for the office park um, in between the Lake Mary and Sanford region. You have really good hospitals in and around Lake Mary and Sanford as well. So you've got a big hospital in downtown Sanford. You've got another big hospital in Lake Mary and Altamont and Longwood. So you've got really good employment in and around all of Seminole County.
Hmm. Definitely. Medical is definitely one of the drivers that we've been seeing on some of the properties we bought in Orlando for demographic of where people are working. Um, so I guess moving further south, talk to us a little bit about first of all, downtown Orlando, the CBD, and then maybe some of the other markets
Yeah,
further south as well.
yeah, for sure. So obviously, if you're coming down the Orlando the I-4 corridor from Seminole County heading south, you to get into downtown Orlando. Downtown Orlando has 13 million square feet of majority of Class A, Class B office space. Orlando on the west side of I-4 has now built out the Newark Kia Center, which is where the Orlando Magic played. They converted the old Orlando Magic stadium to now what is known as the UCF in downtown. So UCF has built a campus in downtown Orlando, which now has several thousand square feet of new office space and student housing and multifamily deals coming online. So you're seeing EA Sports is building a large office um, building there on the west side of I-4. So typically the west side of I-4 in downtown Orlando was a tougher area, but the formation that they've done over the past couple of years with now UCF being there, bringing on the Kia Center. They're actually about to break ground on a new entertainment district in the west side of I-4, which is right next to the Kia Center, where the Orlando Magic play. We've also have a newer soccer team that was formed within the past 10 years. They built out a brand new soccer stadium on the west side of I-4 as well. So there's been a ton of growth on that side with UCF and entertainment. And then on the east side of I-4, which is where the CBD is for downtown Orlando, that's where a majority of your office space is at.
And are you seeing a lot of people living in the urban core, or are you seeing more people still being in suburban? What's like the dynamic there of live, work, play environment in the urban core versus suburban?
Yeah, 100%. I actually live in downtown Orlando. I've been there for about 15 years now. So, yeah, I mean, there's been a ton of new towers built over the past, probably 10 years with 55 West and the View and Modern. So several multifamily buildings, a few condo buildings, but we typically have seen really good lease up rates in downtown Orlando. So occupancy for downtown, the core CBD is very high. Your lease rents and market rents for downtown Orlando is probably the highest throughout the entire Orlando MSA. So, I mean, your 2 bedrooms are pushing in and around like $3,000 a unit, which is very healthy for a 2-bedroom in Orlando. But no, I think it's a different profile of a tenant in your downtown compared to your suburban areas and suburban core areas. But yeah, downtown Orlando is seeing significant rent increases and occupancy is very strong in that market.
Nice. And then I guess moving down towards South Orlando, I guess can you break down some of these markets further south? I know you and I earlier this year worked on a deal and closed on a deal in Conway, which I love. Would love for you to give the pitch on that as well. But I guess break down South Orlando and some of the growth going on there.
Yeah, for sure. So as you move down, we'll stop in the Conway submarket where Bridgewater was, which we closed earlier this year, as you mentioned. So Conway submarket, it's a very strong B+ submarket. You're probably 10 minutes from downtown Orlando. You're 10 minutes from 3 major hospitals in that area. You're 10 to 12 minutes from the international airport. So a very central location. It's very infill. There's nothing really that can be built in and around that area unless you get out towards the airport. So great submarket. I think that area has really transformed over the past couple of years, where it was more probably a B- submarket, but I think all of the majority of the apartment communities in and around that area has been bought by groups like yourself, received significant renovations. And I think some of, the apartment communities have gotten much nicer in and around that area. And I think a lot of the retail has as well. So there's a little submarket in Conway called the Hourglass District, which is a few years old now, but it has new coffee shops and breweries and kind of, trendier restaurants in and around that area. So I think, it's a combination of, new ownership coming in and renovating the retail and the residential. And I think people realize that you're so close to the CBD of downtown Orlando that it's just overall just a great location.
Yeah, we kept doing lunch meetings in this area. It's awesome. I mean, really incredible how that Curry Ford Road has completely transformed.
Yeah, 100%. And as you get further south, I mean, next year Universal is opening their 4th theme park, Epic Universal. So that's going to be a huge development. There's going to be 15,000 permanent jobs coming online next year for that area. So obviously, another good employment driver for that kind of South Orlando hospitality centered region. And then as you continue to move south, you're going to run into the Lake Nona submarket, which is UCF's medical campus, which has seen a ton of growth over the past several years with brand new office parks, brand new medical, brand new multifamily, brand new entertainment and restaurants and retail. So that's obviously a new employment and driver for the Orlando market that has seen, you'll see very high wages within and around that area, which is great as well.
And I guess one of the things to put a little bit of numbers and yields to some of these locations.
Yeah.
How are you BOVing some of these value add deals versus core plus deals? And are they pricing in different ranges based on the various submarkets that we were talking about?
I think majority of Orlando will be consistent for your cap rates, whether it's, the type of an asset it is or the asset class it is. There's a couple uh, different areas within Central Florida that might see some higher yields, like your Pine Hill submarkets, your West Orlando. But really for value add, I mean, for 70s product now, we're being BOBing in place cap rates adjusted for taxes and insurance at like a very high 5 to maybe a 6. I think your 80s product is seeing anywhere from like a 5.5 to a 5.75, and then obviously it tailors down when you get into your core to core plus, or merchant build deals when you're really like a sub 5 on year one, and really just depends on the amount of upside there is for that deal as well.
Yep. And one of the submarkets that we're seeing a lot of development going on is around the I-4 corridor and then all the way down to Kissimmee. Maybe talk a little bit about that, the growth, the construction starts, and some of the market dynamics going on there.
So we had roughly about 12,000 units delivered in 2023, and our peak was this year about just over 13,000 units. So next year it's actually dropping off to 8,000 units. So, and then from there, it's going to fall off even more in 2026 and then, and there beyond. So we've seen a ton of supply in and around the very South Orlando and the Kissimmee markets, which we're seeing concessions throughout those submarkets. Rents have flattened a little bit, but I think really what people are excited about is seeing that supply drop off into next year. So this year, rent growth for the Orlando MSA was flat, where they're now looking at 3% rent growth for Orlando. And then they're actually have us targeted anywhere from 4 to 6% rent growth in 2026 and 2027. And that's all really due to the supply and demand. As supply continues to fall off over the next couple of years, obviously the demand for Orlando, the population growth is not slowing down. So I think people are excited about that metric. I think it was very worrisome throughout this year, 2024, but I think that's changing into next year.
Yeah, I would agree with that. I mean, one of the things that was interesting about the market dynamics in Kissimmee is there was a ton of supply, and it seemed like it was even, it kept going for longer than some other markets. But I think the momentum of it was really due to the demand and the fact that it was all being absorbed so well. And when you're seeing these absorption numbers continue, it allows for developers to justify building. And now you're starting, as you said, starting to see that supply fall off a cliff a bit more. And I think with the demand continuing, and there's no signs of it really slowing down, these could be pretty good buys down the line for sure.
Yeah, agreed. I've got 155,000 new residents that are expected from now to 2027. And I think that's going to continue. So that entire South Orlando and Kissimmee market, I mean, there were some cheaper land options down there too. So obviously that was helpful. But I think it just seems like the corridor of I-4 is connecting from Orlando and Tampa. And that's continuing to show, which is South Orlando, which is Kissimmee, which is continuing to show why there's a ton of supply. But I definitely do think, as you mentioned, it seems like the absorption over the past couple of years and why the developers saw was a very encouraging stat. And that's why you saw some of that supply there as well.
Yeah. I mean, you hear all the time people talk about the immigration patterns into Florida and how Florida has completely transformed as a state. But some people might be thinking that's Miami, or at least someone like me who's an urban guy from LA now living in Miami. You hear Miami a lot, but Orlando is really where most of the immigration has drawn to, and even other unaffordable parts of Florida going into Orlando for that affordability and quality of life, which is incredible. I guess talk a little bit about, the main concern that a lot of investors feel when they think of Florida is insurance. One of the things why I like Orlando and I'm sure you agree, is it's Central Florida. And so you don't get as much exposure to some of the coastal markets in Florida. But in your experience from all the deals you guys have been doing, talk a little bit about how you've been how buyers and sellers have been navigating with insurance.
Yeah, I mean, for me personally, I think insurance was a non-issue over the past couple of years in the terms of we've seen this happen in Florida time and time again over the past, 20 years. When a hurricane or a storm hits us, we'll see insurance spike and then it continues to fall off within the next 2 to 3 years. So if we were selling a deal and we were underwriting and adjusting that cap rate and pricing to, what we were doing last year, anywhere from 1,500 to north of 2,000 a unit. I mean, all that was value creation for the buyer. Obviously, it hit your returns in the first year or two, but as those insurance quotes and premiums are falling, as we can see into this year, most likely it's going to continue into next year. I mean, there was a ton of upside for the buyers. So, I mean, I still think that storyline is there because we're still adjusting for like the low teen numbers for some of the value add deals, 12 to call it 1,400 a unit. And I think by next year, we're going to see that continue to fall. So it's an opportunity for the buyer to just hold through that period and have a ton of growth and appreciation by just holding the deal.
Yeah, definitely. I mean, the way I see insurance is similar to how investors look at real estate. It's a function of capital flows, right? I think we're at a time where there's limited capital flowing into the real estate market, and there's also limited capital flow going into the insurance markets. And what you're seeing from there is now insurance premiums starting to go high. Yes, from risk of some catastrophic disasters that may or may not happen, but more importantly, it's just less liquidity in the insurance market. I think when that liquidity comes back into the market and insurers start coming back into the market, we're going to see, just as you said, insurance pricing stabilize and normalize. And so if you can make a deal make sense today with the insurance today, I think you're going to get paid for it down the line.
Yeah, 100%. And I think we've seen some of the buyer pool in the past, since the insurance market has, it's been about 18 months, has really increased and doubled in some occasions. I think we've seen some of these buyers get on the sidelines. I think that's the exact opposite of what you should be doing if you're an opportunistic buyer looking for value. Because all those guys that have bought in the past 2 years, yes, interest rates have been high, but the value creation that you're going to see by insurance, if you bought at 2,000 and then it's going to drop to $800 in 2 years, I mean, that's tremendous amount of value, $1,200 a unit over a 2 to 3 to 400 unit deal. They're going to be very rewarded.
Yeah. And I guess like talking in the same tone, one of the biggest sentiments that we've been hearing this year is flight to quality. And I know you focus a lot on the value add space and you've seen how yields have moved in the value add space. One of the pitches that I kind of come back to at that is, yes, flight to quality is very important in regards to risk return profiles of assets. And you're seeing a lot of the core plus stuff in Orlando still trading like in the fives and even sub 5, as what you said. But if you're seeing value add deals at, even 100 bips or higher, it starts to get really interesting. I guess talk a little bit about the value add space in Orlando and how this looks. Maybe it's not the flight to quality strategy, but there's still opportunity in the value add space.
Yeah, 100%. I mean, I think a lot of the issues for Florida on the older value add space was the insurance market. So, it was, we heard throughout the year, which is kind of fallen off now, but it was insurers are looking for 1995 or newer, and then it was like 85 or newer. So I think as we see cap rates continue to compress or start to compress wherever we're at in the market today, I think you'll have some of those 70s and 80s deals at 100 to 125 basis points higher than some of your core or, core plus type assets. And I think people then start looking for yield. Like, where's the yield? Where are people not at right now? And buyers are always asking me, it's like, hey, where should we be looking in Orlando, or what type of assets we should be looking at. That's why me and you talked so hard on Bridgewater, and that's why I pitched you guys hard. Like, listen, this is a deal type that people are scared of insurance right now. They're scared of 70s because of the insurance market, but you can see the yield that you guys bought that at. So I think once cap rates kind of compress on the newer stuff, people are going to be looking for that yield, and that's when they're going to start chasing the 70s and 80s again. I mean, we've seen it time and time again, and I think we'll probably start to see that into next year.
Yeah, there was like there was a post I came across the other day that was making a case for older products being functionally obsolete, and I completely disagree with that. I just think it's really a blip in time right now where there might be a good buy for something newer because it's below replacement costs and the JVs are off, and you're seeing those 5 caps getting done on the newer stuff. But as cap rates begin to compress with the JV equity and the REITs starting to come back into the market, these value add deals are going to follow that. And as people start to look for yield, and if you can buy a deal today that can stand on its own 2 feet, on an older product deal that has positive leverage and has a strong yield and has great bones. So, not every old deal, not every 70s deal is built the same. And Bridgewater is a great example of that, that's been well taken care of and ran well and is a great community and people want to live there. In no way is that functionally obsolete. That's a deal that's going to do really well in the near term and in the long term.
Yeah, 100% agree. I think there's, a lot of these older deals were built in some very infill locations that are great, like the Conway submarket, which you guys rent. You can't build new there. And, if a tenant wants to be close to, the trendy coffee shops and restaurants and what have you, then that's where you're going to want to live. And that's where they'll rent at.
Yeah, exactly. And these older deals have stood the test of time, and exactly what you said, they've been in neighborhoods that have been developed for generations and generations and have character. And
yeah,
there's nothing that can really replace that.
Absolutely.
I know we've touched a lot in different areas about supply, and we talked about the optimism there. What would you say out of the different markets does the supply picture look most promising? Where you're a betting man, you're like, I would like to buy a new construction deal in X neighborhood. Where are you seeing the supply getting absorbed the best, and you think is a good opportunity to buy?
Yeah, I mean, supply. I mean, if you can find anything in the Seminole County submarkets for newer construction, I think that's definitely the way to go. As we touched on in the beginning of the conversation, yeah, I mean, just families want to be there. There's not as much supply being delivered in Seminole County, but that's just a function of, as we were just mentioning, it's somewhat infill and it's somewhat built out in some of those areas. So, yeah, I mean, obviously, Seminole County for sure. I think out by the college UCF, which obviously will be a little bit more student based. But I think those areas, if you're in and around, like Winter Park, your Oviedo's, which is in Seminole County, I think those are the markets that you can find. I mean, Kissimmee right now, as we touched on, has some supply issues, but as we mentioned, yeah, that's going to be fading off into next year.
Yeah, so like the Seminole County deals, I guess what would you say in general the yields are there today versus what they were during the ZIRP era, the zero interest rate period era?
Yeah. I mean, we were selling deals during that area in the low three cap range, and now we're probably on year one, probably sub 5, kind of your core plus type stuff. Value add, I still think regardless of where it's at, the 70 stuff is still, around a 5.75 to a 6, your 80s a 5.5 to a 5.75. But your newer core stuff, yeah, I mean, you can see that, the delta in cap rates there. And also we're not just a sub 5 on in place, but we're sub 5 adjusted for that insurance number that we talked about.
Yeah. So, and that's a very important caveat, right? That it's a tax and insurance adjusted today adjusted. And I think you're going to see some upside down the line. Obviously can't underwrite that in no way, but protecting that downside by underwriting insurance today. And one of the things we did is we got a master policy in place to stabilize the insurance figures year over year, and reduce that volatility. But as you start to see the capital flows come back into the market, not only in real estate, but in insurance, I think you're going to definitely see some strong upside from the insurance expense.
Yeah, 100%. I agree.
I guess one other question: what's the biggest mistake new investors make when they're entering the Orlando market?
I think some of the groups, I mean, I'm speaking about the value add assets. I think some of the groups, they come in and they're not running the assets properly. I think that there's a lot of, 70s to 90s deals that have a ton of upside, but you got to implement the business plan. I don't think, we're not back in 2000 in the end of 2020 or 2021 where we're seeing record number of organic rent growth. So I think if you're underwriting a deal and we're presenting a deal and we're showing you the upside, if you guys close and then don't implement, the interior renovations or the exterior renovations, which we've seen happen in the past couple of years, whether it's due to difficult times or not, I think that's the mark that's been missed. Also just like being attentive, just being in ownership that's staying in contact with your on-site team, whether it's, weekly calls, bi-weekly calls, just on, hands-on management from the upper end and showing that on-site team that you're there and you care about the asset. When you're not, having calls with them, then they feel like, maybe the deal is not so important and there'd be, your on-site team is kind of just running the property as is. So, I mean, if there's a vacancy issue and you're unaware of it and they're kind of just making decisions on the fly, that might not be the best result for the property. It's, in short, implement the business plan if you're underwriting to interiors and exterior renovations, and definitely be hands-on with the property.
Yeah, 100%. I think us being vertically integrated is a huge step and a huge benefit for implementing the business plan, being nimble with the business plan too, right? Like recognizing when to tweak the business plan accordingly based on anything that may come unexpected, and just having a hands-on approach for everything. It's super important.
Very important. Yeah. Very hands-on. Yeah.
Yeah. I think on our deals in Orlando, we've had a business plan, we've executed on it, but then we've seen things that were curveballs to us that were like, okay, let's test the ROI on this. Let's test if it makes sense to do this or not. And I think just being nimble, especially in a volatile market that we're in today, it's very important. Also being on top of delinquency. I think that's like one of the number one thing. I think in Orlando, you see a little bit less of that than in some other Southeast markets, but you still see it. I think maybe a lot of late payers. So just being on top of people paying and working with the tenants and having that personal touch with tenants and working with them, instead of just, pushing pencils and trying to do things behind a desk.
Yeah, 100%. Yeah, it seems like the deals that are struggling the most is from on the ownership side that are just not paying attention to the property, or they don't know what's going on with performance. So yeah, I mean, you guys do a great job, and if you can, try to show up to the property.
Yeah.
Also the ownership side, stop it. You don't have to go there once a month, but would be there. Make sure that the on-site team knows that you're reachable.
Yeah, I mean the deals that might be struggling operationally, we're there minimum once a month at this point, and some of the other deals that are cash flowing, okay, someone from corporate is there once a month, maybe not the asset manager every time, maybe I stop by while looking at acquisitions. Like someone just needs to touch base, and it goes a long way. A long way.
Agreed.
I guess, you mentioned some of the deals struggling. Have you seen this wave of distress that people are kind of hoping for as buyers, or and if you have, why, and if you haven't, why? I would love to hear your take, I guess, in the past year or two on what you've seen on the distress side in Orlando.
Yeah, no, that distress story has not come at all. So, um, the blood in the water, we haven't seen it. Obviously, I think everyone, it's been, a bit of a slow year. I think a lot of the buyers were thinking that there was going to be some real opportunities this year, and they never really came. And it seems like, if that property or that sponsor's in a tough position, they're figuring out some way um, to kind of kick the can down the road a little bit. And it seems like they're having success in some way or another. So now that we're starting to see the market, recover some, quickly, I think there's a lot more optimism in the market today than there was 2 months ago. And it seems like we're going to be feeling that into next year. And, maybe that kind of blood in the water is not going to show its face at all.
Yeah. Yeah. I think there's definitely some bleeding going on nationally. But
Right.
as you said, I don't know if they're really translating to sales, right? There might be rescue capital, recaps, other forms from A to Y before going to Plan Z, which is selling at a complete loss. And especially in Orlando, you're not seeing it because operationally, I think Orlando's just still doing great. As you said, there might have been flat rents or a little bit of an uptick in vacancy, but it's nothing compared to what you're seeing in some other markets. And units are still getting absorbed. People are still paying rent. Still is a promising outlook. So, and it's Florida, and you have the fundamentals and the story and the lifestyle.
Yeah,
So
100%. Yeah, we've been blessed. I mean, Orlando and a lot of the Florida markets have done great over the past, year, to, 18 months. Yes, it's been slower, but I think performance has really held for a lot of the assets throughout really all of Florida and specifically Orlando, which has really helped all of those owners that were potentially in a tough position.
definitely. I guess last thing, before we started recording, we were talking a little bit about NMHC.
Yeah,
Um, what are you expecting out of NMHC?
I think people are excited for 2025. I think this, a lot of obviously we're starting to see rates come down, interest rates come down. We're starting to see insurance come down. I think the supply and demand issue is going to change into next year. So I think there's a lot of the buyers that are saying now is the time to get back on the playing field. Because as soon as we're off to the races, I think we're going to be moving real fast. So I think groups finally realize it. It's like now or never. And if I was a buyer and I had, all $20 million, I would be hunting for deals now to get something before things really turn around.
Yeah, I agree. I mean, I think there's definitely more optimism. I think with Treasury still above a 4, it's not as big of a push today as it was when Treasuries were at like 3.5
Right.
in October, where you really saw the push. So I think that deflated things a little bit. But I think once we get back to a sub 4 Treasury and maybe some stronger operational upside with spring leasing and getting back into some of the lower insurance stabilized rates, just some stability
Yeah.
that I think we're going to see in 2025.
Right.
You're going to start to see the bid-ask spread start to narrow.
Right. I think we're starting to see that now. Seems like, the deals we've been calling for offers on and working through best and final over the past month or two, it seems like the bid sheets are starting to stack up. Pricing starting to be more aggressive. So I think we're going to see more of that into next year. And yeah, I think NMHC, I think a lot of the NMHC 2024, there was a lot of optimism, but then it kind of fizzled out and we went nowhere.
Yeah.
So hopefully it will be the complete opposite this year where, we're off to the races in a much different way.
Yeah, there was definitely some optimism that died very quick after at NMHC.
Yeah.
And this year felt a little longer, obviously, but I think 2025. Everyone kept saying in 2020 January of 2023 NMHC they were saying survive to 25.
Yeah.
Here we are.
Yeah.
So I guess we'll find out if it's survive to 25 or survive through 25. We'll see.
Yeah.
We'll see
Exactly.
where that heads out.
Yeah.
But Ryan, really appreciate it. Thanks
Yeah.
again for hopping on to Deal Flow Friday. And yeah, I guess I'll see you in January. I guess I'll see you at NMHC.
Absolutely. Thanks for having me. Look forward to seeing you in Vegas.
Awesome.
Absolutely.
Thanks.
Thanks.